Now, the global regulatory reform process is moving from policy making to the implementation phase. While there are still new policy initiatives in areas such as the fundamental review of and the leverage ratios, policymakers are now devoting most of their resources to national implementation. For more on how the compliance regulatory landscape is starting to shape how African banks will do business in future is Suresh Chatu, Sector Director at Banks and DFIs at RMB. Thank you so much, Suresh, for making the time to chat to us today. Now, I want to start off with the key pressures that are facing US and European banks at this time. What are the major pressures that they're having to take on?
Well, Nisipo, ever since the subprime crisis, banks have been under pressure to review their regulatory regime. And this is extended far beyond just the normal KYC and AML. There's been quite a bit of focus on how the consumer is treated in the US and the UK, and particularly in terms of transparency regarding pricing. As a result, there's a number of regulations that are now coming out of the US and the EU, which would have an impact in terms of the African banking landscape. The second most important point is that banks are reviewing the type of business that they've been traditionally in.
Right.
And now they're starting to focus on their core businesses. I think there's been a lot of pressure by banking regulators to say, look at focusing perhaps on more of your domestic franchise, and we are going to start to curtail your international franchises. This means that bigger, larger international banks are now reviewing their focus and, in terms of the business they've been doing with a number of banks in Africa, and some of them are possibly exiting the markets.
Let's dig a little bit deeper into those compliance issues in particular. When we talk about these stringent regulations that are facing the banks in the West, if I may still use that term, but we're saying that the impacts are going to be felt on the African shores. Now, talk to us a little bit about, in granular form, what are these compliance changes that are likely to come through?
Well, I'll give you a very topical example, which I just heard in the news today, is HSBC Egypt, for example, who have been in the country for a number of years, have decided to exit the SME business. Now, this is one of the key focus areas of Egypt, and possibly a focus area for a number of years for HSBC. I'm not too sure of the reasons for this exactly, but it all points to banks revising their policy frameworks, the type of businesses that they are in. One, not only from a business strategy, but also from a regulatory and compliance strategy. Just remember, Nisipo, it's becoming extremely expensive to maintain a large compliance framework, not only from a human resource, but the amount of systems, energy, and IT infrastructure you need to control the number of transactions, the number of counterparties, the multiple currency and regulatory regimes in each of these particular countries.
But how should African banks be responding then at this time?
Well, they're already starting to invest a significant amount into infrastructure from a compliance perspective. I think we are going to see African banks investing a lot more into compliance and adhering more to the international standards of compliance. South Africa, for example, is a FATF member, and our South African Reserve Bank regulates that banks maintain, as for example, enhanced due diligence on high-risk countries. This is very, very intense work. It requires a lot of man hours in terms of KYC and AML. And I expect a lot of more African banks will need to comply in terms of going through the same process. But it's all driven from the top, from what the country's regulatory regime is. And I'm expecting, I've just come back from Cyprus now in Dubai, and this has been a core theme. I expect a lot more of the central banks in Africa to start pushing this type of regulations to African banks. So I expect a lot more focus on compliance in terms of AML, KYC, in terms of the regime, but also a lot more resources in terms of IT and manpower being put to this area of the banks in Africa.
Let's look at the notion of global governance. I mean, one would say that this is the absolute ideal, where we have one governance structure that is applicable across the board. Are we anywhere near that ideal?
Very, very difficult. The core reason for this is that you're dealing with multiple regimes and multiple regulatory environments in those particular regimes. Not all countries in Africa, for example, subscribe to FATF for that much, across the world. There are a number of observer nations. There are a few countries or a number of members that are FATF members. But until you find one sort of uniform legislation across all banks, it's extremely difficult. Also, you've got to understand the maturity of the banking regimes in various countries. Some are far more immature and honestly cannot afford the amount of regulatory compliance and oversight that's required from, say, a very developed market player.
And despite the variable changes we might see, as you've pointed out, based on the maturity of certain banking sectors, do you think that capital and funding strategies across the board are going to be impacted on?
I don't think so. I think what's going to happen is that, banks, for example, South Africa banks are Basel III compliant, or are required to be Basel III compliant from the 1st of January. What you are seeing that those regulatory changes will be impacted by regulations like Basel. Most African banks are either on Basel I or Basel II, and I think Basel will regulate the regulatory reform in terms of capital structures for banks in Africa. I don't think that the major regulations like Dodd-Frank or FATCA will affect the sort of capital structures of what banks are required to keep. Right. Those are going to be largely driven by the local regulators.
Suresh,